Well, the Fed meeting was interesting because although there was no change in language in the statements, and in particular the phrase considerable period stayed in the statement, what did change was that the forecast that accompanied the statement, the quarterly forecast, saw an increase in the number of Fed participants expecting rates to increase next year, and the end point for interest rates at the end of next year was increased. And there'd also been a Fed paper released a few weeks before by the San Francisco Fed, in fact, highlighting the importance of the so-called dots or forecasts of the various Fed members for interest rates as guidance towards where interest rates are going to be. So it seems as if the Fed was actually being quite subtle in its way of communicating to the market and to investors, and rather than changing the language this time, focused on changing the forecasts and the dots, but we still think that a change in language is coming soon as well, and that will be the next step in terms of preparing the market for rate increases in 2015. So we've been expecting the US Federal Reserve to begin the process of gradually tightening monetary policy for some time now. So we haven't necessarily changed our asset allocations as a result of recent developments, because to some extent we've been expecting those anyway. And our view is that we still think the US economy in particular is in growth mode, is recovering from the credit crisis. When we look more globally, it's a little bit more mixed. There are some areas of weakness, such as the Eurozone, but also some areas of strength. But at the global level, still the recovery continues, and valuations for so-called risk assets, such as equities, still look attractive for us on a relative basis to the safe haven assets. So when you look at all that together, we still overweight the risk assets on a global level, and the forthcoming tightening by the Fed doesn't change our allocation, but we are aware that there will likely be some volatility for those asset markets around the period of the first rate increase.